Good morning to all. Welcome to my channel. Today we will be discussing the under management accounting, that is marginal costing. Marginal costing, we have discussed the basics concept of marginal costing, marginal cost, and the problems under normal conditions of marginal cost. Now we have to see a special situations where decision making purpose part has come. Three types of situations we have to take the decisions. That is one, pricing decisions, make or buy decisions, and accept reject decisions. You see, out of the three options, your pricing decisions is very much important. What price has to fix for your product, it is a very typical type of things and serious work for your these things. So you have to see that what way this pricing to be done under different situations. Suppose if you are to take an additional offer in such situations, basic concept is that you have to do your incremental cost and incremental revenue comparison questions will come. So under normal situations you have to see that your cost plus percentage. Even then also you cannot just like that cost plus percentage, you cannot do all the situations, as because today's market is the buyer's market, not seller's market. Whatever amount you cannot sell in the market. Number three options is there, that is your the pricing under abnormal situations. Abnormal situations means you if your product are not even selling at the break-even point, sometimes you have to sell at loss to stay in the market. So many decisions you have to take for your pricing decision purpose. So today one of the situations we will be discussing where your this spare capacity is there, but at the same time you have been receiving one order, and simultaneously the situation is that your factors of productions have changed, and at the same time you have the compulsion, you need not to increase your selling price. So these are the conditions you have to price for the quoted price for the additional sales. So here one problem we have given here, this is a company's manufacturing product marks an average profit of rupees 2.50, 2 rupees 50 paisa per piece on a selling price of rupees 14.30 by producing and selling 6,000 pieces or 60% of the capacity of sales. You see that here itself this good point is that it has been underutilized capacity, that means some spare capacity is there. Second conditions they have given that thing, direct material cost is 3.50 per unit, direct wage is this 1.25, works overhead 6.25, 50% fixed, that means 50% variable. Sales overhead 25%, that is variable is 0.80, 25% variable, total cost is 80, then variable is 0.20 and fixed will be 0.60. Now these conditions they have given during the current year he intends to produce the same number but anticipates that fixed charges will go up by 10%, with direct labor and marginal material will increase by 8% and 6% respectively, but he has no option of increasing the selling price. You see that his fixed costs and direct material, direct labor increases, fixed cost also increases, but he has the compulsion, he cannot increase his selling price. So this is one option. Under the situation he obtains an offer for further 20% of the capacity. What minimum price you will recommend for acceptance to ensure the manufacturer and overall profit of is 16.230. So these portions you can see here, these portions, minimum price 20% of the capacity, what minimum price you 20% of the capacity or minimum price you will recommend for acceptance of the order. So Now we will come to your solution part. So how we can make the solutions? You see that we understand that whenever you have to take the additional order, you have to see that your incremental cost benefit analysis you have to make it. So let us start with that. His existing situations, what happens? You see his selling price is 14.30. Selling price is 14.30. Okay, so material cost, you see from here 3.50 per unit. But what happens, your material cost has increased here 6%. So we are adding it 6%, that is 3.710. Similarly, your labor also 1.25. This is also increases 8%. So 1.25 become 1.35. Works overhead, what they have given, 6.25, 50% fixed, that means 50% variable. 6.25 is 3.125. Sales overhead, 25% variable, that means 0.80 means 0.20 is your variable. So total your these things variable cost has come 8.385. Now your contributions per unit is your selling price minus your variable cost, your contributions per unit, your 5.915. Now you have to see that this is the per unit contribution. So you have to calculate your at the level of 6,000 unit, 6,000 multiplied by per unit contribution, that is your total contributions comes to your 35,490. Out of this total contributions, you are to get the profit, you have to minus the fixed cost. You see, fixed cost, your works overhead your fixed is 50%, 6.25 means 3.125, and sales overhead when is 25% variable 80, your 0.60 is your fixed. So total your fixed cost will be per unit 3.725. For 6,000 unit you are getting 22,350. Here one concept is there, your this fixed overhead also, just like your material labor, fixed cost also increases by 10%. So your that 22,350 adding 10%, it becomes 24,585. So under the keeping your selling price intact, your profit comes to your 10,905. Okay, so you what way you have to make it your this profit to become 16,750. For that purpose we have to go some next stage calculations part, we have to go for that. So that is there. You see, your 10,905 here, this profit is there. So next part for your very important for your calculation part. How we will be doing for that? You see that computation of selling price of the order. So as we told, no, you got the order 20% means 2,000 units, 60% becomes your 6,000, 20% your 2,000 into your contributions per unit, your as in your earlier calculation is 8.385. So this comes your 16,770. Now you have to see that to fix the price, you will recommend, no, what minimum price you will recommend. Here they are telling that you have to recommend to make a profit of 16,770. So 16,770 minus what you have to do, you have to do what profit you have already achieved. So that balancing figure you have to take here, 16,770 minus 10,905, because that is your existing profit. So you have to add, your required profit will be this additional. So that figure is 5825. So this is the total figure comes 22,595. So you have to make per unit selling price. So how many units you have for 2000 lots? Rupees 22,595 by 2000 comes to your 11.30. That means this additional sales of 20% capacity, in order to earn a profit of 16,730, you are to fix the price of 11,030. So here you see that why we are this figure plus additional rate, why we are adding that? Because of that already we have earned 10,905 in our existing productions profit. So you have to some balance profit also we have to get it. So that is your, once your fixed cost recover, your contribution is equal to profit. So your base contribution is these things and additional contribution is this much. So that will be your selling price for your that 2000 unit. So this is the total concept for our this pricing decisions part. In my subsequent video, I will go for some other decision purpose, that is make or buy decisions and accept or reject decisions. You see that in my description box, the basics, whatever marginal costings, other chapters, you can see these things. Please do subscribe to my channel so that whatever new videos will come, it will come to you. We are ending the video here. Have a good day.